Economic crises are often described as moments when everyone loses. Yet history repeatedly shows that the wealthiest individuals frequently emerge even wealthier. This paradox has appeared in nearly every major financial collapse over the last 2 centuries. During recessions, unemployment rises, businesses fail, and governments struggle with debt. At the same time, asset ownership quietly shifts toward those who already control capital. The mechanism behind this pattern is not mysterious, but structural. Financial systems tend to reward liquidity and punish those who rely on income rather than assets. When credit expands during economic booms, asset prices rise rapidly across housing, stocks, and land. Wealthy investors benefit first because they already own the majority of these appreciating assets. However, when the cycle reverses and a crisis begins, asset prices suddenly collapse. For individuals dependent on wages or debt, these declines often trigger financial distress. Wealthy investors, by contrast, frequently hold large cash reserves or liquid capital. This liquidity allows them to purchase valuable assets precisely when prices are lowest. The result is a transfer of ownership that occurs quietly during recessions. Assets leave the hands of distressed sellers and move toward those capable of waiting out the crisis. Economic historians describe this process as a balance sheet recession. Debt burdens force weaker participants to sell, while stronger balance sheets expand their control over productive assets. The pattern has repeated across multiple economic systems, from early industrial banking crises to modern financial markets. Each crisis appears unique on the surface, yet the underlying structure remains remarkably consistent. Understanding this pattern requires examining how modern credit economies function. Economic growth is often fueled by expanding debt rather than purely by productivity. Governments borrow to stimulate economic activity, businesses borrow to expand operations, and households borrow to purchase homes and education. During stable periods, this debt appears manageable and even beneficial. Problems emerge when debt grows faster than the real economy. At that point, financial stability begins to depend on continuously rising asset prices. If asset prices stagnate or decline, borrowers suddenly struggle to service their obligations. This is the moment when financial stress begins spreading through the banking system. Banks respond to rising risk by tightening credit conditions. Loans become harder to obtain precisely when struggling households and businesses need financing the most. The contraction of credit accelerates the downturn. Companies cut jobs, consumer spending falls, and government tax revenues decline. Yet financial crises do not affect all participants equally. Individuals with large financial reserves can remain patient, while others are forced into rapid decisions. Wealth concentration, therefore, tends to increase during severe recessions. Assets that once supported middle-class prosperity often shift toward institutional investors or wealthy individuals. A clear historical example occurred during the financial panic of 1873. The crisis triggered a global depression that lasted much of the decade. The collapse began after excessive railroad speculation and banking leverage in the United States and Europe. When major financial institutions failed in September 1873, credit markets froze almost instantly. Thousands of American businesses closed during the following years. Unemployment surged as factories and railroads halted expansion projects. Despite widespread hardship, several industrial magnates expanded their holdings dramatically during this period. Investors with available capital purchased railroads, land, and industrial equipment at distressed prices. By the early 1880s, economic growth returned and asset values recovered. Those who had purchased assets during the panic saw extraordinary long-term gains. Another powerful example occurred during the Great Depression beginning in 1929. Stock markets collapsed after years of speculative borrowing and rapidly rising share prices. Between 1929 and 1932, the American stock market lost nearly 90% of its value. Banks failed across the country as depositors rushed to withdraw savings. Ordinary families lost homes, farms, and businesses during the early 1930s. However, investors with cash reserves were able to buy shares of major companies at historically low prices. Several famous investment fortunes were expanded during these years. Long-term holdings purchased during the Depression later became enormously valuable as economic recovery unfolded. The structural explanation lies in how crises reshape financial leverage. Borrowers must liquidate assets to repay debts, while lenders and cash holders face no such urgency. In practical terms, this means the most indebted participants sell first. The least indebted participants often become the buyers. Economic downturns therefore function as a kind of financial reset. Ownership structures shift, even if the underlying productive assets remain unchanged. The housing market provides a clear example of this mechanism. Property values often collapse during financial crises due to forced sales and foreclosure waves. Real estate investors with strong balance sheets can purchase properties during these periods at significant discounts. Over time, rising rents and property appreciation generate large returns. The global financial crisis of 2008 illustrates this pattern in modern markets. Excessive mortgage lending created a housing bubble across the United States and parts of Europe. When housing prices began falling in 2007, millions of borrowers suddenly owed more than their homes were worth. Mortgage defaults quickly increased across the financial system. Major banks faced severe losses because mortgage securities had been widely distributed throughout global markets. Financial panic intensified after several institutions collapsed or required emergency support. In response, central banks launched unprecedented monetary interventions. Interest rates were reduced to near zero while governments stabilized major financial institutions. These policies prevented complete financial collapse, but produced another important effect. Extremely low interest rates pushed investors toward financial assets in search of returns. Stock markets began recovering within months of the crisis. However, many households remained financially damaged for years afterward. Institutional investors, private equity funds, and wealthy individuals began purchasing large numbers of distressed homes. Entire neighborhoods of foreclosed properties were acquired at discounted prices. By the mid-2010s, housing prices had recovered significantly in many regions. Investors who purchased during the crisis saw major increases in property values. At the same time, housing affordability declined for many younger households. Ownership shifted gradually toward large investment groups and established property holders. The same dynamic occurs in financial markets more broadly. Stock ownership is already concentrated among wealthier households before a crisis begins. When prices fall sharply, those with cash can accumulate additional shares. Over time, this increases their share of corporate ownership. Monetary policy can unintentionally reinforce this outcome. Central bank interventions often stabilize financial assets more quickly than wages or employment. Rising asset prices therefore benefit those who already own significant financial portfolios. Individuals dependent primarily on salaries experience recovery more slowly. Another structural advantage comes from access to information and financial networks. Wealthy investors frequently employ professional analysts and advisors. These experts monitor market conditions and identify distressed opportunities during downturns. Access to specialized knowledge improves investment timing and risk management. In contrast, smaller investors often react emotionally to market volatility. Fear during crises leads many individuals to sell assets near the lowest prices. Behavioral economics research has repeatedly documented this pattern. Panic selling locks in losses while disciplined investors accumulate assets. Credit availability also differs dramatically between economic groups. Large investors often maintain established relationships with banks and financial institutions. Even during downturns, these relationships can provide continued access to financing. This advantage allows major investors to act, while others remain constrained. Governments sometimes reinforce these structural advantages unintentionally. Emergency financial programs frequently prioritize stabilizing large institutions considered essential to the economy. These interventions protect the broader financial system, but also preserve the capital of existing asset owners. The result can accelerate wealth concentration during recovery periods. Historical data confirms this pattern across multiple economic cycles. Wealth inequality in many countries has increased following major financial crises. After the Great Depression, wealth concentration initially declined due to taxation and regulatory reforms. However, later financial cycles again demonstrated how crises reshape ownership structures. The inflation crisis of the 1970s provides us another example of structural advantage. Rapid inflation eroded the real value of fixed wages and savings accounts. However, owners of real assets such as commodities, land, and businesses often benefited. These assets adjusted upward with inflation, preserving or increasing real wealth. By contrast, households holding only cash or low-yield savings experienced declining purchasing power. Inflation therefore redistributed wealth toward asset holders. Economic crises often involve both deflationary shocks and inflationary responses. Governments attempt to stabilize economies through monetary expansion and fiscal spending. These responses can eventually lead to currency depreciation or rising price levels. Again, those holding tangible assets frequently benefit from this adjustment. Gold, land, and productive businesses historically retain value during currency instability. Wealthy investors typically allocate portions of portfolios to such assets. Ordinary households, however, often concentrate savings in bank deposits or pensions. These forms of wealth are more vulnerable to inflation or financial restructuring. Another important factor is time horizon. Wealthy investors can hold assets for decades if necessary. During severe downturns, patience becomes a powerful advantage. Those forced to sell immediately rarely benefit from eventual recoveries. Long-term investment horizons allow wealthy investors to ignore short-term volatility. Market declines become opportunities rather than existential threats. Financial crises therefore operate like economic stress tests. Participants with fragile balance sheets exit the system while stronger ones expand. This does not necessarily require deliberate manipulation. The structure of debt-based financial systems naturally produces these outcomes. Economists often describe the process as creative destruction. Weak firms and investors fail, while stronger ones reorganize productive assets. However, the social consequences can be severe. Rising inequality often follows major financial disruptions. Modern global finance has amplified these dynamics through interconnected markets. Capital now moves across borders within seconds. Large investment funds manage trillions of dollars in assets. Their scale allows rapid deployment of capital during crises. Smaller investors rarely possess comparable resources or market access. As a result, recovery periods can widen existing wealth gaps. Recent economic shocks illustrate the persistence of this pattern. The financial turmoil triggered by the 2020 pandemic created sharp market declines, followed by rapid recoveries. Governments introduced massive fiscal and monetary stimulus programs to stabilize economies. Financial markets rebounded quickly as liquidity surged through the system. Meanwhile, many small businesses permanently closed during lockdown periods. Employment disruptions affected millions of workers worldwide. Asset prices, however, rose sharply after the initial panic. Stock markets and housing markets reached record highs within a few years. Investors holding diversified portfolios benefited from this recovery. Individuals without financial assets experienced slower economic improvement. This divergence reflects the fundamental structure of modern financial capitalism. Ownership of productive assets determines long-term wealth accumulation. Crises accelerate the transfer of those assets. Distress forces rapid decisions that reshape economic hierarchies. Governments often attempt reforms after severe downturns. Banking regulations, deposit insurance, and monetary policies evolve following each crisis. These reforms can reduce certain risks, but rarely eliminate the underlying cycle. Credit expansion eventually resumes as economies grow. When borrowing again outpaces productive growth, vulnerabilities reappear. Financial markets gradually rebuild the conditions for future instability. The cycle of boom, crisis, and recovery therefore continues across decades. Each phase redistributes assets within the economic system. Wealthy investors are not immune to losses during crises. However, their structural advantages often position them for stronger recoveries. Access to liquidity, diversified portfolios, and long investment horizons provide resilience. These factors transform market collapses into opportunities. For policymakers, this pattern raises important questions about economic stability. Preventing crises may require addressing excessive leverage before it accumulates. Financial regulation attempts to slow dangerous credit expansion. Yet political and economic pressures often weaken restrictions during boom periods. Investors and households therefore operate within a system shaped by recurring cycles. Understanding these cycles becomes essential for long-term financial resilience. Historical analysis shows that crises rarely arrive without warning signals. Rising debt levels and speculative asset bubbles often precede collapse. When these warning signs appear, disciplined investors begin preparing defensively. Liquidity and diversification become critical strategies. Those preparations can determine outcomes once markets begin falling. Prepared investors gain flexibility while others struggle to react. Over time, the cumulative effect reshapes the distribution of wealth. Ownership concentrates among participants capable of navigating repeated crises. This dynamic explains why economic downturns often produce unexpected winners. Wealth shifts not because crises create value, but because they reallocate it. The underlying factories, land, and companies usually remain in existence. Only their owners change. For observers, the lesson is not that crises are beneficial. Rather, they expose the structural incentives embedded within financial systems. Debt amplifies both prosperity and vulnerability. When expansion ends, the system demands repayment through asset liquidation. Those with capital available during liquidation periods gain leverage over the future economy. They purchase the foundations of the next growth cycle. As recovery unfolds, these assets appreciate again. The cycle quietly reinforces existing economic hierarchies. Understanding this pattern helps explain one of the most persistent paradoxes in economics. Periods of widespread hardship can simultaneously produce concentrated financial gains. Economic crises therefore function as moments of redistribution rather than simple destruction. Wealth changes hands even when total production temporarily declines. The deeper insight is that financial systems reward preparation and liquidity during instability. In a debt-driven economy, those who can wait often inherit the future.